Everyone. Well, Chris Lopez here. I got Terrance Doyle with me. So we had the idea a few weeks ago, in addition to the Ride Along show, because we had so many great questions from YouTube, Instagram, people messaging some BiggerPockets to actually start doing some YouTube lives to answer the questions. And hopefully as we do this, we can start building some people actually come on live with us while we do it. So I'm in the green. I'm Chris. Terrance over there in the black. And the video screen is doing whatever it wants to do. It'll fix itself eventually, hopefully. But we're excited about this because actually the quick history on the Ride Along show is about 2 years ago. Terrance and I started working on this project just for ourselves, do some local marketing. And then we heard that BiggerPockets was looking to do some more content. We showed the idea to them. They liked it. We've gotten great feedback. And BiggerPockets is getting the green lights to us do more shows, do some more Facebook lives, YouTube lives, do questions on here. So we're going to start running through some questions on YouTube and Instagram. And as you guys are watching this live, please type in the comments box, and we are watching those live comments as well. So Terrance, I know you had a question from Instagram you want to start off with, right?
Yeah, I get this question or a different form of this question a lot, and it has to do with a cap rate. And I know everyone is falling in love with this term in multifamily cap rate. So it comes from Patrick Miller, and he says, I have been marketing Atlanta and Nashville to all multifamily owners and have seen some leads. Do you get strict with a cap rate rule or focus on equity and cash flow when underwriting multifamily properties? So my response that I gave him is I don't ever limit myself based on cap rate. To me, cap rate is almost a meaningless term if you're looking to buy value add construction heavy properties. So, cap rate means in layman's terms, what is the yield? What's the return going to be on an annual percentage basis? So if I put in $100, $1,000, $1 million, what am I going to get back? And what is that in a percent term, interest rate term? And so for me, if I'm going to look to do construction and add value, a lot of construction and have a lot of occupancy or a lot of vacancy, not a lot of occupancy, the current cap rate is almost meaningless, right? Because I'm going to be doing renovations, so there's going to be a lot of vacancy. So the real metrics that I look at is what am I going to buy it for? And then what is it going to cost me to renovate it? And then what are my rents conservatively after construction's done? So really what I want to focus on is how much total dollars am I going to have into the deal? And then what is the rent or the NOI, net operating income, going to be once I'm done with that construction and I've rented it?
Yep. And I think your response was great because, I mean, as you said, cap rates could be kind of meaningless. Plus, depends how you underwrite it. Like we buy properties, I've seen agents, hey, this is a 9 cap.
Exactly.
I underwrite it as 6 cap because the way we account for expenses, especially for value add stuff, it doesn't really matter on the buy side, but it does come in play if you want to do the exit strategy and turn around and sell it or refinance it. 100%. Hey, what's the refinance, or I'm sorry, what's the value of the property once it's updated, brought up to market rate and stabilized? And that's where that exit cap rate is good for selling or doing the refi to put in a longer term debt.
Absolutely. Yeah. Everyone underwrites cap rate differently. They're going to have different property management fees. Taxes can open down after you have renovated it. And based on how the city or the county does their assessed value. So cap rate to me, if you're going to do value add projects, is meaningless.
All right. So we got already some comments coming in here. So I'm going to, I see a couple here saying, hey, should I buy a house? Is this a good time to purchase a quadplex? Should I buy a property now? So I think as a general theme, whether you're buying a house or fourplex, those are going to be, residential investments.
That's right.
5+ or bigger is commercial investments. So Terrance, let's just say, is this a good time for someone to buy a property? I got my question or my answer. You go first though.
Yeah, I don't have a crystal ball. So in terms of predicting the future and what's going to happen in the next 12 months or 24 months, I can't tell you if the market's going to go up or down, based on where you live. A lot of this is market specific. I think what's interesting is that, during the last, the global pandemic, the last 90 days, New York has completely depreciated. I think 20-30% price drops across the board in Manhattan. But if you look at Denver's actually appreciated from a year ago. And I think it's something like 8 to 10% from, single family residences are up 8 to 12% from this time a year ago. So, when you start talking about, is it going to go up or down? It's very market specific, but in general, I like disciplined investing. And if you find a property regardless of what's going on around the country or globally. If you find a property that fits your buy box and your underwriting and is going to meet your financial needs, I think it's a great time to buy. But you have to be disciplined. First of all, you have to take a step back and say, okay, what are my goals and what is my criteria? And if you find a property that meets your criteria and is within your budget, I think it's a great time to buy. It's always a great time to buy.
I agree with you. So, I mean, I'm active right now looking for another rental property. I know Terrance is buying, a bunch more value add stuff right now. And so I agree, like, it really depends on your market.
Mhm.
Like Denver right now, jobs are coming here, people are coming here. So we have demand increasing.
100%.
That keeps rents going up and prices going up. So from a very high level, I look at supply and demand. That's like my very high level one. Secondly, like, I don't know what your market is, but find the data on there. I know like nationally, it's like, I think it was like 80s, high 80% is like the rents collected that I saw from like a National Apartment Association report. Right. But in Denver, from the PMs I've been talking to, they are collecting anywhere from about, anywhere from about the low 90s to 100% of their rents collected. And so they're all saying, hey, this is basically what we're seeing last year. Most of them are within like 1% of where they were, right. May last year, June last year, July last year. So rents are being paid. So that doesn't scare me. Now, this is a Denver market. I know where you're at. The other thing that I've been doing is I have increased my cash on hand. I've already been pretty conservative, but I'm like, hey, I keep 6 months per property. Now I'm keeping 9 months per property. And so I'm keeping more cash on hand because interest rates are low. Denver's still growing. In 10 years, I'm not worried about it. I just want to make sure that I don't lose it in year 1 or year 2.
That's right.
So that's my attitude.
I think the key there with your perspective, which I really like, is you're a long-term. You're looking at it long-term. So you're not worried about if I need to sell it in a year or two. As long as your plan is to hold, pay down debt, collect cash flow, and you're disciplined with your underwriting, I think it's always a good time to buy.
Yeah. Man, lots of great questions here. So Shiloh says there are many small up-down multifamily. So that's like a unit up top, a unit downstairs are prevalent in my area. Would you suggest that this is a good starting point for rentals, or would the hassle of noise complaints be too much? I would be the property manager. My answer is no. I mean, if you're worried about tenants living above, tenant B above tenant A, for most rentals, nothing to worry about.
Yeah, we haven't had any issues with up down versus side by side. Again, I think it comes to knowing your market, understanding what your investment criteria is, and if the property is in a safe area and you can meet your rents conservatively in the pro forma, I'm not too concerned about the configuration of the property. Yeah. That's an interesting question, though. I haven't heard that one before.
Yeah. And I mean, obviously, if you go in there and renovating it, it's a good thing to keep in mind, but don't not buy a property just because of that. I mean, yeah, that's how tenants are in apartment buildings. Like, it's not a big deal. But if you're going there and renovating it, great. Put flooring in there with a pad, or spend the extra 30 cents a square foot so it's got the pad underneath, or whatever you need to do to make it a little bit nicer. But overall, like, that would not be like a deal maker or breaker for me. I don't think for you either.
If you're in a really high end neighborhood, like in Denver, like a Cherry Creek, I could see there being some pushback. But if it's in a safe neighborhood, tenants are mostly used to that, sharing a wall, sharing a ceiling with someone that's at their floor. It wouldn't stop me from buying a property if all the other boxes were checked.
So here's a good question from Chess. Chess says, do you consider CapEx, repairs and maintenance, and vacancy into the cash on cash return? He is currently closing on a single family home. If he takes these items into consideration, the cash on cash is around 5%. But if he doesn't, it's around 12%. So this goes back, like, honestly, like, your numbers are the same. This goes back to what Terrance was saying earlier, like how, he underwrites a cap rate one way versus the other way. So, what happens in real estate, if you're the listing agent or seller, you write it at 12% cash on cash.
Right.
If you're the buyer agent, you write it at 5% cash on cash return. Now, personally, I underwrite all that in there: repairs, maintenance, CapEx, vacancy, all that stuff, because that's a cost. Even if you don't incur it that year, you should be putting aside a few bucks every year for eventually when your water heater or windows go out.
Roof, yeah.
So you underwrite it too with all that stuff too, right?
Yeah, absolutely. I mean, that's just real estate. There's going to be repairs and maintenance. There's going to be vacancy. So you have to factor that in somewhere. If you're not, you're basically just like fooling yourself. You're not being transparent. And especially if the property's for yourself, you're just basically, you're costing yourself money. and or deceiving yourself, however you want to think about it. But yeah, you're not doing yourself any favors by not factoring that in. So I would factor in a very conservative vacancy rate. So if the average in your market is 3, go to 5 or 6, double it. And if repairs and maintenance in your area, property manager is saying it's $50 a month, then I would go to 75. Always be conservative. So yeah, and if the project doesn't fit after you're conservative, then you just move on.
All right. So question from Micah here says 1031 question. How soon can you refinance the property without causing any red flags with the IRS? So we can't give you an exact answer. Your best person to talk to is your 1031 QI or qualified intermediary. So my experience with 1031 QIs is they're kind of like lawyers. Yes, 3, you'll get 3 different answers. Because they're interpreting those, I don't know, that section, the IRS code, ever how many paragraphs it is, right, and they have their own interpretations. I've talked to some QIs, they're very aggressive. Others are not, are a lot more conservative. So talk to your QI or talk to a couple QIs. But I've gotten some really creative ones over there where they've like escrowed money to do repairs and kept them 1031. They've refinanced it. Like you can get creative, but talk to a few 1031 QIs and get their opinions on there.
Yeah, 1031 and your accountant. I think those two working together is a good mix. And yeah, I don't want to get in any trouble, so I'm going to not comment on that. I have an interesting comment here. Infamous Panda. Hey, Chris and Terrance, can you believe that I'm a 14-year-old kid who used to sell candy at school and now I'm going into real estate? And it's so fascinating. I just want to give a shout out to Infamous Panda.
Awesome.
I love that. I love it. From someone that used to sell baseball cards and mow lawns in high school and now is in real estate. I think it's amazing to take entrepreneurs that were in middle school and high school and see what they're doing now. So keep up the good work, Panda.
Yeah. Keep it up. And the biggest piece of advice I got for you is, I mean, I'm probably almost 3 times your age now. Be patient, man. When I was in the business, I was about 21. I got serious about business. I was selling candy and baseball cards when I was young. But like, man, when you're 14, never feel like you get old. When you're 21, 30 is so long off. Life is long. Be patient and play the long game. That's something Terrance and I talk about all the time with us and people we mentor.
That's right. Be patient.
All right. So let's see. Follow-up question. Miguel says, what is a QI? So that's short for qualified intermediary. So when you are in a 1031 exchange, which is that a section of the IRS code that allows you to basically defer capital gains. So if I bought a property in 2010 and I'm in 2020 selling it, let's say I've gotten, $200,000 in equity. If I sell that, I'm going to pay a big chunk to Uncle Sam in capital gains. So first off, good problem to have. But if you work with a 1031, when you sell the property, your proceeds from the property actually go sit in the qualified intermediary or QI into their like trust account. And if it doesn't touch your bank account, that's how you can defer capital gains. Now, there's a lot more rules on there. Go to BiggerPockets, search the forums or blog posts. I've seen a lot of really good 1031 guys post content on there. So the forums and blogs has great information on that for like mechanics.
That was well said, Chris. That was a really thorough explanation. I enjoyed that. Yeah, that was well said.
Yeah. Let's see. Let's go here.
Louis
says, I live in New York City, and I was wondering, is it a good idea to invest in my first rental property here, or should I move somewhere out of state? So first off,
I love that
loaded question.
I love it. Yeah, I love it. I know where he's going though. I see where he's going since we just talked about Manhattan.
Yeah.
Louis, I think that, one of the first things is that I would need to understand your goals, what kind of cash you're sitting on and what you're looking for. But generally speaking, if I lived in New York City and I wanted to get into real estate, I think now's an excellent time to be buying because it's low. There's a lot of people scared. A lot of people leaving New York. I just know in Denver alone, talking to residential brokers, there's a lot of people from the East Coast moving to Denver, moving to the West Coast.
There's a lot of New Yorkers.
A lot of New Yorkers moving here. So what that means for me, Warren Buffett and a lot of other really smart people, what they say is when other people are afraid, be bullish. And when people are bullish, be afraid. So I think that I would be buying into the fear. I would obviously, you have to come back to how much money do you have and what are your goals. But if your goals are, like we just talked about, being patient and a long-term investor, I love taking down a rental property in New York City right now. I think you're going to get some good value. And I think in 20 years, you'll be looking back and you'll be pretty happy.
Yeah, I agree with you. It just depends on really what your goals are, the numbers, all that stuff. I'm a big proponent of investing in your backyard.
Right.
I think it's always like the first thing to look at.
100%.
Now, Terrance, you invest here. You also are very successful in Des Moines, Iowa.
Yeah.
And I mean, Des Moines, Iowa has been great, but you've taken a few black eyes in there as well.
Yeah, we've had a lot of bumps and bruises along the way. I think, if you're going to go out of state, Louis, we've done some podcasts on that. I think there's a lot of good literature on BiggerPockets. There's some other really good podcasts on BiggerPockets. The punchline for me, if you're going to go out of state, is you have to have someone that is vested in the property with you. You have to have interest aligned with someone on the ground that's going to look out for you. If you're just trusting a third-party property manager that you don't know to have your back, you're going to be disappointed. But I think generally speaking, I would be buying into the pain of New York right now, as long as you're disciplined and you have a long-term perspective.
Yeah.
I think buy New York.
All right. So Bruce Whelan says, what do you guys think about adding an Airbnb to a single unit dwelling to achieve the 1% rule? Zoning doesn't permit splitting the unit into 2 units. The long-term rental will cover most expenses. So you're talking about, kind of depends. I'm not sure if you're talking about converting the unit to an Airbnb, or having converting having the home be the long-term rental and converting the basement to a short-term rental. So my biggest advice there is neither of us are big fans of the 1% rule. Don't get fixated on that, because that's just a very simplistic rule meant for like a sniff test. So don't base your whole thing off of that. For Airbnb and zoning, if you're newer, I would really just play by the rules. Don't get creative. I've seen a lot of people get bit in the butt with trying to do something, and zoning comes back and bites them in the butt. So if you buy a property like that, different question, might be grandfathered. And if you're in there doing the work, I would not try doing under the radar, but then going through zoning variances is usually a pain in the butt.
Yeah, I think, Bruce, depends on the city. There's some cities, I think the smaller the market, the less jurisdiction there is around this and the rest policy. Obviously, as you get into larger cities where it really affects hotels, there's a lot more enforcement on it. But generally speaking, I love house hacking. So if you can hack up the house and separate the basement or, a side entrance to where someone has their own unit inside of your home or your property, I think that's a great move. It just depends on the market and what you can do. But I think looks like right now you're talking about your basement into Airbnb. And I don't even know that you need to Airbnb right now. I think you could just get a separate tenant. There's short-term nurses that are looking for places that my wife and I have worked with. And there's a lot of different options to get people to supplement your income that are tenants. But I would actually compare, what it's going to cost to run the Airbnb in your market. You can look at a website called AirDNA, and it'll give you kind of the averages in your market. That's just some, one to check out. There's other resources. But I would look at, the expenses of the Airbnb versus what you can get just having a traditional tenant. And I'm not sure that Airbnb really is ahead right now with how few people are traveling. So you might be able to do better just as a traditional tenant in your basement.
Yeah. Here's so many good questions here. So I want to start with this one on multifamily underwriting. So Matt Hendrickson, and Terrance, you answer this first. So when underwriting a multifamily deal that is either new or recently updated, can I assume a premium on rents as compared to comped properties that have not been updated in the past 2 years? If so, what would you say the premium is, and is it too insignificant to account for it in the pro forma? So that is a good question.
Ding, ding, ding. I think that's a great question. That's the first time I've used that today, but I think, Matt, that's a great question. Okay. The short answer is you should not assume a premium on rents. We're in the middle of several multifamily acquisitions right now. And even though we will renovate the units, I am taking the rent comps off of unrenovated units, just because I think that we're coming into a season. The last 6 to 8 years, based on where you've lived, most likely rents have gone up every single year, almost across the board. 3, 5, 7, 8. Sometimes in Denver it was 10%, but it's gone up every single year. I think we're going into a season where rents will not be going up. People are going to be very price sensitive. And I think you need to assume that rents are static for the next 2, maybe 3 years, and just be very, very conservative. So I would not assume a premium on rents. I would be very conservative. I would put yourself in the position of the tenant. And if you're looking at 2 properties, they're the same rent, but one's updated, one's not, your building's going to be full while the other one may have more occupancy. But if you start raising it $50, $75, we may be going into a season where people will take an outdated bathroom, an outdated kitchen for less money. Whereas I think we're coming out of a season where people are willing to pay the extra $75 or $100. And trust me, I was a big, benefactor of that. We got those rents because we updated it. And I think we're going into a season where if I'm going to have updated units, I'm going to try and be the same price as the outdated, because I know that our buildings will be full. So I would look at occupancy versus rents right now, pushing rents. You just want to be full.
Let's go with this question from Cody. What are your thoughts on purchasing a newly built duplex for my first house hack, or an older home requiring light renovations? I mean, we can't give you a clear answer, and it really kind of just depends on, location, numbers, all this. It just depends on so many factors here, because if this is your first house hack, hey, you can I'm assuming you use an FHA loan. That's what most first time, multifamily owners are using. And FHA is generally like a use it or lose it. So if numbers make sense, I would probably go with the newer build property, just because you should expect lower CapEx and repairs. But at the same time, if there's, good value add and there's a lower price point, especially like a price to rent ratio for that older home requiring light renovations, underwrite with the higher repairs and maintenance. But if you can go in there and add the value, increase the value, maybe refinance it a few years later, both are good options. So just run the numbers.
I would hope that if you're going to start doing renovations, your returns are going to be higher. So one of them would be more turnkey. I'm guessing the newly built duplex you're probably going to pay a premium for that, but you're going to have it's turnkey. And the other one, you should be getting a higher return. So it just comes down to what your full-time job is, how much time you have, and what you're looking for on your return. But yeah, if you're looking for something turnkey with less hassle, the duplex, if you want a higher return, I'm hoping that the older home should generate a higher return. And
you have to look at the market here, because Denver is a very much like strict seller's market. And so a lot of times you go out there and buy like a recently renovated property, like a flip property. They don't sell for much more than a property that's got the 1970s avocado green appliances. So going there and buying that older property that needs a bunch of updating usually isn't worth it there, unless you get like a really good value add play, which is hard in Denver.
That's right.
So you have to look at the market conditions as well. So it's a great question. Unfortunately, it's like a complicated answer.
Matt had a follow-up question, it looks like.
No, we answered that.
Okay, cool.
Yeah. Let's see. Where do we want to go here? Let's start with Rashawn. Rashawn says, hey, I am looking at a ranch with a full basement with an opportunity to value add another unit. What should be included in my due diligence for adding that basement unit? So first off, make sure you talk to like a local realtor or lawyer. So, we got to give that disclaimer there. You want to start with that one, Terrance?
So looking at a ranch with a full basement with an opportunity to value add another unit. A full basement. Oh, okay, so you're going to add a unit in the basement, it sounds like.
Like a mother-in-law suite.
Right. I would underwrite, obviously, if you're going to have to borrow the money for construction, so I'm underwriting the capital you're going to need. I'm going to underwrite the interest that's going to take, for 4, 5, 6 months, whatever it's going to take to do that. I am going to underwrite additional insurance. I think when you're doing construction, insurance goes up. What else would you underwrite there?
Check the zoning as well, because a lot of times those single family homes, they're zoned single family. And, at least here in Denver, while you're living there, if you rent out the basement, no big deal. But when you move out, and if you rent out, unit unit to person A, bottom unit to person B, a lot of times you're violating the zoning code. Again, that's got to be your preference. I would like to add on here too. I work with a lot of, I'm an agent here in Denver. I do a lot of work with house hackers, and I've had a lot of house hackers say, great, I found this home. I want to convert the basement to like a finished basement. Well, construction cost, materials, they've gotten high in Denver. A lot of times to convert the basement is going to be like $30,000, $40,000 job to put a kitchen down there, plumb it. Like, it gets expensive, add egress windows, all this stuff.
Right.
And it's like, hey, you're going to spend 6 months doing that. And then you're, if you move out a year or two later by the next house hack or your next future rental property, that $30,000 you spend is next down payment on property number 2. So to date, I've had yet 0 clients build out a basement, but I've helped dozens of people buy properties that wanted to. And after they ran the numbers, they said, no, let's buy a place that makes sense as a future rental property, save all that money, and that will be my down payment for property number 2 at like a 5% down conventional.
Yeah, I think that's an excellent point. You really have to understand the back end value when you do that, and if you can still sell the home, or if you're just planning on holding it for cash flow, and it doesn't matter what you really do to it, and you're just going to cash flow it, and you're fine holding that in perpetuity. But I would really want to understand from a local realtor what the value is going to be, how you're going to affect the value one way or another by doing that. But that's a really good question, and something I think you're looking at. I think you're asking the right questions, trying to understand what to underwrite.
So Brendan Wilson says, when you are looking to find investors, do you have a specific template that you follow on how to present the information to them, or some type of blueprint? And I'll let you answer this, Terrance. But Terrance, I've been friends for a couple years now, and I've really seen his real estate business grow. And I mean, every year you've hired better staff, you've gotten more organized. So it's going to be like, I think, a transition, because you have definitely, like, every year is getting better and better and more organized. So like, kind of tell people what you did in the beginning when you're obviously like a lot scrappier, and now you've got a CFO helping you out with things. So like, walk us through that.
That's a loaded question. We could talk about this for quite a while. Looking to find investors. I think the first thing when you're trying to find investors is you really have to have empathy, and you have to put yourself in their position. Money is so hard to come by, and especially kind of coming out of a global pandemic and going into some uncertainty. So you just have to, I think the number one thing when you're talking to investors, regardless of the dollar amount or the project, is to really understand that, the investor wants to hear that their money is going to be safe and they can trust you. I think that's the number, 1 and 2 things is, do people trust you and do they like you? And they have to feel like you're going to treat their capital as precious as they do. And that's, to me, the investment is 3rd or 4th on there, and your track record and all the other things, come after that. I think the number one thing I would focus on is really trying to put myself in whatever position they're in. Are they, what season of life are they in? Are they married? Do they have kids? Are they single? Do they have a really established career? Are they in a volatile career? You really want to, I think, just speak to where that person's at. And the more that you can speak to that, and they feel like you understand where they're at and how precious that money is to them, and that they can trust you with it, I think the deal really becomes irrelevant at that point. Because even if the deal goes bad, if they really trust you and they feel like you really care about their money, they know you're gonna pay them back. And so I don't know. I mean, I feel like obviously, the way that I've presented investments has changed over the years, and the way that we communicate and the way that we show it, and obviously the spreadsheets have gotten more complex over the years, but I think that's always been my core value, is that when I meet with people, I'm really understanding, because I've lost money from other people before. I've lost a lot of money. And so I know how painful that is. I know how hard it is to make money. And I think that really comes through when I'm meeting with anybody on any kind of deal, regardless of the size, and is just really understanding how hard it is to make money, and how much I'm going to, they can trust me with it. So,
yeah, and I think you nailed it, because I mean, it's not so much the way you present the information, but it's the context around it.
Right.
So, I mean, keep it simple, stupid when you present the information. The BiggerPockets calculators, hey, plug it into there. They print out that nice, couple page PDF or report. Hey, that's plenty. It looks good. It shows numbers. It's plenty presentable. Hey, cool. That's good enough. And it's all the other stuff Terrance talked about, because that's where it's going to actually get the deal. So don't hang up on there. Keep it simple. And it's that relationship and the talking that's going to be, I think, the important factor.
Yeah, I think one of the tips I would give is that you want to assume worst case scenario. I think, telling me how much money, if I'm putting myself as this person that's going to invest in you, telling me how much money I can make is irrelevant. I know that if things go well, we can make a lot of money. I want to know the plan for when things don't go according to plan, and all the risk. And I think really leading with that, if I sit in front of someone new and I'm just talking to them about all the wins I've had, but I'm not going to tell them the losses and where the mistakes I've made and how I've learned from that. So I would say, like, one tactical thing you can do is talk about the pitfalls you've had, talk about the lessons you've learned, talk about the risk and how you're going to mitigate those risks.
Yeah. Hey, here's a great quick reminder, because we will be doing, we got more ride along shows coming out. We'll be doing more lives as well to do Q&As. So make sure you hit the bell notification on YouTube. So that way you get the notifications on YouTube as we do more shows and do more of these live shows as well, because this is fun answering these questions. All right, let's see here.
There's one about Miami down there. You see that? Lipsy.
Okay, Lipsy says, I'm in Miami, Florida. It's an expensive market like Denver. I want a residential investment portfolio. At what point do you switch to commercial real estate?
Well, if it's already expensive, switching to commercial only gets more expensive. So I'm not sure that switching asset classes makes a lot of sense. But I think you could just expand where you're looking in Miami. So if one or two or three of the zip codes are really expensive, like in Denver, if Denver and Littleton and Lakewood are too expensive, then maybe I go to Longmont, Broomfield, and Castle Rock, or I go to the Springs, but I still stay with somewhere within 45, 50 miles. I would maybe just expand where you're looking. If you want to be in residential, then stick to residential. I would just expand your search criteria and where you're looking, as opposed to switching to commercial. I
think a lot of it too just depends on the opportunities out there. Like, I mean, hey, what are the returns like for residential versus commercial? Like, hey, if you're in a position to house hack, great, you can go buy a residential property for 5% down. You can't do it with commercial. Commercial property, you're going to be putting down pretty much 25% down, if not more, a lot of times.
Right.
So I've seen a lot of investors. One of the things I like to do is, I like to interview and network and meet investors in all stages of their like investing arc.
Right.
And I've noticed a lot of investors, they start with residential because it's simple, it's close to home. Maybe we've all lived in homes and apartments before, and it's lower down payment. And then as they get older and their net worth builds, they often trade up from houses to apartments, and then apartments to like commercial or office buildings.
Right.
Because they're getting a less return, but now they're in that retirement age, like, hey, cool, I want less headache and a more stable property. So there's so many factors in there. But I would first say, hey, cool, look at your situation, look at the market, and say, hey, what property can you realistically buy in the next 6 months or 3 months to 12 months? And it's better to get in a deal now versus waiting for the perfect deal over the next 5 years.
Yeah, and I think, especially if you're getting started, it's not about if you're going to make mistakes, you're going to make mistakes, you're going to lose money.
Yeah.
So you'd rather do it on a property that's $100,000 or $200,000 and you can recover versus a $1 or $2 million property that could wipe you out. Ray Dalio says, it's never a failure if you stay in the game, but you just don't want to get wiped out. So I personally learned a lot from flipping homes, having single family rentals, made a lot of mistakes, lost a lot of money, but I stayed in the game, and then I was able to, grow into apartments. So I think starting out is really smart in residential. And if the price point's too high and where you're looking, then maybe just expand the search.
Man, so many good questions here. So, Enrique, yeah, my mouth's landing on you. So answer your question. I'm in South Texas. I had a house with market value of $175,000 to $185,000. I owe $87,000 at 3% over 10 years. Already approved up to $400,000 for a fourplex. Should I sell my house and buy more real estate? So yes to buying more real estate. Obviously,
always.
Yes to buying that. Should you sell your house? It depends. So here's what I do. So like if you have a single family home you're living in, run the numbers today as if you're repurchasing a property. Now go to the BiggerPockets calculator, type in today's purchase price and today's rents and today's expenses. Not what you bought it for, nothing that matters. Hey, but if you were to repurchase it as an investment property, what's the number look like? And I learned this trick for one of my mentors out here in Denver. And if the property is revalued today like a 4% cap rate or lower, again, depending on how you write cap rates, 4% cap rate or lower, hey, he sells it and 1031s it. And that's his trigger for doing it. So I like to look at if you rebuy it today, because that's a good trigger. Hey, it might cash flow, but if you're able to walk away with $100,000 equity and re-leverage up, that might take you from 1 unit to 6 units. And that'll build you more wealth in the long run. Yeah. So that's my very simplistic answer.
I think I know the mentor that taught you that, and he's very successful. So that's definitely a great piece of advice. The way I've always looked at this, because a lot of my friends ask me the same question in Denver, they bought 2 or 3 years ago. It's appreciated a lot. And they're like, should I take it and go do something else with it? On this particular scenario, I would really want to understand what you can rent that house for that you owe $87,000 on. Because I'm guessing the mortgage at 3% is like $300 or $400 with property tax. Maybe you're at 6 or 7. I'm guessing you can rent it for 1,200 in cash flow. And then you could pull out a line of credit, a HELOC on the home. If it's worth 185, you can probably get an extra $60,000, $70,000. And with that $60,000, $70,000, you can probably still go buy an investment property and you're cash flowing your house with the HELOC. And then you still own the 4 other units. And then I would just continue to scale that up. I started out doing that. I took out HELOCs on my residential. I have a HELOC on my residential now that I used to buy a 20 unit in Denver or something last year. So I'm a big fan of if it cash flows and you can hold it and you've locked in that fixed interest rate at 3% and it's going to cash flow and you feel good about the area. I like the idea of taking the HELOC and then using that to go buy a 4-plex.
I agree. And the other thing to keep in mind, because interest rates have nosedived since COVID, look at doing a cash out refinance too. Because I did this earlier this year. I got a ton of clients doing it. Like, hey, do a cash out refi, and you locked in that cash out at a 3.5% increase for 30 years.
That's really
and
good.
HELOCs are floating, at 4% right now, as I've seen. So look at, I like the idea of taking out the cash, but look at both look at selling, look at HELOC, and look at cash out refi.
That's a great point. Yeah, that's good.
Because you just got to lay out all the options and see what the spreadsheet says. All right, Lucas. Lucas says, I'm a young teenager living in an expensive market, Toronto, Canada. Do you have advice on how to begin developing my portfolio? I think we'll have the same answer for this one.
Lucas in Toronto. My dad's actually from Toronto, so we have a lot in common. My advice would be, I would look to build relationships with some older guys. So maybe guys just out of college, early 20s that are in real estate. Look to build a relationship with them, job shadow them, follow them around, spend as much time with them as you can. And when you're ready to buy, I would still stay in Toronto, but I would just look, like I said, on the suburbs. Look, maybe 30, 40, 50 miles outside of the downtown. And I guarantee you'll be able to buy, find some better deals to get your feet wet. But I think, the key, if I could go back and I was in high school, I would try and find, the hungry hustler agents in my area and just try and spend as much time with them, try and learn, hear their conversations, see how they're handling contracts, see how they're looking at deals, see how they're underwriting. You're going to learn so much more being in the passenger seat of their car, driving around with them, watching them, than you will, I think, almost doing anything else. I'm big into action. So as opposed to reading and listening, I'd rather just get in the car with those guys and build some relationships. And I think that'll pay off long-term.
All right.
Someone had a question about a personal residence there. Should we go on that one?
For this one?
Yeah.
Okay. So Micah asked, can you 1031 your personal residence?
This is one of my favorite topics, actually, when it comes to real estate, because a lot of people don't know that your primary residence you can sell tax-free. And I think that's one of the biggest advantages that our IRS has, our tax, the Treasury Department has given to U.S. citizens, is if you own a home, you can sell it every 2 years tax-free.
Yeah.
It's massive. You can't own Facebook, you can't own stock, a company, or anything else and sell it and it be tax-free. The only thing you can sell tax-free right now that I'm aware of is your primary residence.
Yeah. And you have to know the rules, because you have to own the property for 2 of the last 5 years, right?
Has been your primary 2 of the last 5 years.
Can we share, because I know you're selling your primary, can you kind of share the numbers on that, or what you've done on there? Because I know you've done this a few times to build capital. I was
able to talk my wife into this. A lot of people don't know it, which I think is really interesting. I think when people reach out to me and they don't own their own home and they're saying, hey, how can I get started in real estate? My first piece of advice is buy a primary residence. Buy it. If you want to get in, if you want to do the fixer upper thing, HETV, buy a fixer upper, learn all the lessons, get that out of your system, right? And then own it for 2 years, sell it. It's tax-free. You can roll that up every 2 or 3 years. If you do that every 2 years, you're almost adding, depending on the market you live in. Like in Denver, I've had friends that do it and they're making 6 figures every 2 years. So it's adding $50,000 a year to your salary, basically tax-free, just by buying a home, being disciplined in the neighborhood that you want. And so, my wife and I have done it the last 4 years. So we've purchased 3 homes like that. We've sold 2. We're in the process of selling our second. And the first house we bought for $345. We put up maybe 100 into it and we sold it for $740. That was right before our first child. And so once you get into a market like Denver where the homes start to appreciate a lot, once you net over 500, then you start to pay taxes. It's $250 if you're married, $250 per spouse.
And of course, check with your CPA. We gotta give that disclaimer.
But I think it's a great way to supplement your salary or your full-time job and you just get to learn real estate, and you're living in the home. So if construction goes bad and you end up spending more money, you can just you're going to live in the home anyway. And then when the market, once it catches up, you can sell it. But I think the number one best way to get into real estate investing is buy a primary residence. And if you can house hack it, even better, and sell every 2 years.
Agreed. Here's a good question. Is that
Mihan?
Mihan? Hopefully I didn't butcher your name there.
Vukovic.
So thanks for the great content on BP. Do you have any advice for a new investor? I have one single family home right now to doing larger and bigger multifamily deals like you. High level tips to get from point A to point B.
I got to reread this. I'm a slow listener. Do you have any advice for a new investor to doing larger multifamily deals? Yeah. So we've talked about this. We've talked about this a lot. I think the advice that I did myself and give out is I would find someone that is doing larger deals and find a way to add value to them. If you love real estate and you know that you want to go deeper and you're in single family homes now and you're like, man, I want to do larger multifamily deals, find someone in your market that you can job shadow, you can build a relationship with, and find out a way that you can add value to get into one of their deals. If you don't have the capital, maybe you have relationships with banks. If you don't have that, maybe you know some contractors. Maybe you can help with being an on-site property manager. Maybe you can help him find his next deal. I mean, there's 25 solid ways to add value to guys like myself in markets doing larger deals. I mean, I had a guy that I had a relationship with for 2 years. I think I met him on BiggerPockets or Instagram. And he just recently brought me a deal during the pandemic. We closed on it in June. And I think it was the largest deal he's ever done. He was just a wholesaler and he had built a relationship, wanted to get into multifamily, and we ended up closing on it. So there's a bunch of ways. I think building relationships with someone that is kind of where you aspire to be and just finding ways to add value.
And I agree. I'll add kind of the way I've done them, because I've had very good success in real estate in my previous business by getting in with like just very high level mentors.
Mm-hmm.
But what I purposely did not do was I'd say, hey, can I go out there and buy a cup of coffee or lunch? Because someone, who's already out there busy and doing that, they don't care about the free lunch. They care about, they're already, they're probably got more things to do, more opportunities they can handle. So I look for, hey, great. They have their strengths. What is a weakness I can use to go out there and put my strength as their weakness?
Right.
That's how I got connected with Charles out here originally. He was like my very first mentor in Denver. He was a incredibly knowledgeable guy. Great rental portfolio, built a great brokerage, a great agent, great reputation. But he could not market his way out of a paper bag. And I said, hey, I can market. Can we partner on stuff? And it was just a turning into amazing like mentorship, partnership relationship, and help springboard my investing in my agent career. Yeah. So I think you can find like, if my strength complements your weakness,
that's right,
you can get some like amazing, like real relationship and actually start getting stuff going on there.
Yeah. I love how you did that, because you came to a guy that was one of the top brokers in Denver and you were able to add something that he did not really know how to do or have a desire to do. And I think you weren't even living here and you brought him 8 deals, right?
It was like over 12. Yeah.
12 deals. Double digits. Yeah. So you brought a guy that was already experienced, showed him a way to, increase his revenue in a way that he didn't know how to do, and 12 deals, which is there's realtors that are full-time that live in a market that can't do 12 deals a year. So I love that. I love that story.
So I call it like, just trade up your mentorship. Don't go for a cup of coffee, go give value. You on a question here, Terrance?
What's Prince Will?
All right.
Looks like an interesting question.
Prince Will, he says, if you are making about $80,000 a year, what is the maximum price you will buy a home? I live in New York City and do not know other markets to invest in.
Loaded question. What is the maximum price you'll pay? What do they say? Your mortgage should be a third of your salary?
Depends who you talk to.
Oh. Well, if they're talking to you, what do you say?
I say talk to a lender.
Oh. What does the lender say?
So I say,
I thought it's a third or a fourth.
Well, yeah, that's like sounds like a good rule of thumb.
Yeah,
but getting into like more detail. So like it depends on your goals, but also like, hey, talk to a lender, because you can't get fixated on a purchase price. Hey, great, if I go out there and say, hey, I don't want to buy anything that's more than $200,000. So I go out there and buy a $200,000 house, but it rents for say $1,000 a month. But then I see a deal for $300,000, rents for $5,000 a month. Well, obviously I want that other property is much better investment. So, the very first thing I always tell my clients is like, talk to a lender, because the lender will tell you like, hey, what you can or can't borrow, because they're kind of like the real authority in there. And that's come down to your risk tolerance. because Terrence and I both have, two kids right now. And before I was married and before I was single, I had like zero risk tolerance, or I had a lot of risk. I care risk, whatever. I don't care. I still had a wife, I had kids. My risk tolerance was just gone from here, not giving anything, to way over here. So that's depending on your risk tolerance too.
Yeah. I didn't understand if it was for his primary for an investment. Again, if you're in New York City and you can't afford a Manhattan penthouse for $5 million, that's fine. I think you can go 40, 50 miles outside the city and you can find properties that will fit your return profile. The key is, we go back to like the fundamentals. You have to know what you're looking for, what your goals are, and what kind of returns you're looking for. So I think if, sounds like you have a really stable job and you're doing really well. And I think you can back end into, hey, what are my goals in 5-10 years? And what is my desired return profile? And then you can go out and find properties that fit that.
All right. So we'll wrap up in a few minutes. We got time for 2 more questions. And I got to pick this one from D. Colbert. He says, any idea why Southwest Virginia or Northeast Tennessee investors? So I'm from Virginia, went to Virginia Tech, so I love Southwest Virginia. Any idea why investors are so unwilling to do rent-to-own lease options? Was a perfect or balanced win-win agreement for that? So I don't have a great answer for you. I just wanted to give a shout out to Southwest Virginia.
To the location.
Yeah.
I've actually never done a rent-to-own lease option.
I haven't either.
I've had tenants in Des Moines approach us with that, and it does sound good. And being the, loving, big-hearted guy that I am, I've wanted to help our tenants buy their own homes. But what I've found through consulting with my attorney is that it almost just always ends up bad for the person that is selling the home. You have to pay taxes if you sold it in Iowa, at least. You have to pay taxes if you sold it that year, even if they're just paying you lease payments. And there's a lot of liability on my end, on the seller's end. So it probably has something to do with the legality of it in your market. I think some states are different than other states with that. So you'd have to check with your attorney. But I know we've tried to do that and helps out some of our tenants and try and incentivize them to buy a home. But it just never, the practicality and how it actually plays out, it normally doesn't end well for the seller, or the landlord. So I'm guessing that's probably what's going on in your neck of the woods.
Yeah, anyways, I've never done it either, so I just wanted to shout out to Southwest Virginia.
Approach us with it, and every time I run it by my attorney, he's like, don't even waste, it's just not worth it. So.
All right, last question here from Brendan, and this is a great current events question. What do you guys think about applying for a deferred forbearance from the CARES Act, where it pushes the payments to the end of your mortgage and you use the rental income to save for a down payment? So what he's talking about here is that, when COVID hit, Congress passed that law where you have a loan with Freddie, Fannie or whatever, you can go into forbearance. And that basically means, I think it's up to 3 months. You don't have to make any payments. They have to talk to your loan company here. So I've talked to a lot of lenders about this and some clients as well. So it makes sense. Hey, cool, I could defer my mortgage payments now and save, $5,000. But make sure you understand, hey, there's a consequence to the back end there. And these rules have changed a handful of times. And this is just me from, following lenders I work around town with. Because the rules indicate if you're in forbearance, you couldn't get another loan for 12 months. And now I think that timeline has dropped. So make sure you talk to a lender that knows the rules and make sure you go out there and, Google it, for lack of a better way to research it and understand it, because, hey, great, might make sense. But if you shoot yourself in the foot and you can't get another loan for a year, it kind of defeats the purpose in my mind. So personally, I'm not going to do any of that because I'd rather just, play it safe. But make sure you understand the consequences, because there is a, things downstream.
They tack it on at the end, yeah.
Yeah, anything to add on to there?
I thought you did a really good job. We didn't take advantage of any of the forbearance, so I can't really speak to that. No. It's actually, when I read the question, I thought that was pretty crafty. So I don't know. I do know that they are just adding it onto the end of the mortgage. I think a lot of the local banks and even national are not even adding fees to that. But I would definitely check with someone to see what shows up on your credit report if you do that. Yeah, just make sure you understand the rules, because, I've had some conversation with lenders, just us kind of BSing in their office or over a cup of coffee. And they're like, dude, I have this person, they have this all figured out, and they're an idiot for doing this because now they can't get 2 more loans. And that's very much the off
camera talk. There's kind of people sharing stories on there. But I've heard some already people shooting themselves in the foot. So really make sure to understand the consequences.
I like where your head's at, though, Brendan. If
Yeah.
I were you, I'd use that same craftiness to just go find another property and go raise the money. It sounds like you got a good head on your shoulders. So I think you can figure it. That was smart.
Here's the other way I would look at it too. And depending on your financial situation, now, if you have to go in the forbearance, absolutely do it. But if you don't, look at refinancing. Interest rates are so low right now. Right. I refinanced my home in November, did a cash out refi. I was at like 3.75. I was like, great, awesome interest rate.
Right.
And then in March or April, I refinanced again to 2 7/8 because interest rates dropped so much.
I think you just commented it's 1 year of deferred maintenance. If they're giving you 1 year of deferred maintenance, I think it's definitely going to show on your credit report. So I don't think you'd be able to use that cash for a down payment if they're giving you 1 year. I think that would definitely show up. Yeah,
just talk with a lender and tease out all those scenarios. All right, guys. Well, this has been awesome. Our plan is we got more ride-along shows coming out. We got more lives coming out. So our plan is to, as we get in the groove of these shows, we'll release a new show on Wednesday. The following Wednesday, we'll do another live to answer questions from the comments or come on here as you guys are live here. This has been awesome. So make sure you watch the show when it comes out tomorrow on Wednesday. And also make sure you subscribe to the channel and make sure you click that bell icon on the video to get the actual notifications from YouTube as well. So guys, thank you for listening. Terrance, thank you.
That was awesome. Thanks, Chris.